Hi, everyone. This is Michael Del Duca. I am CEO of Team Erie, and I'd like to introduce our management team. Allison Krieger, CFO, Jason Meading, COO, and Ernest Purcell, CSO. Thank you for attending our analyst briefing, and let's get right into it. The Erie team showed consistent financial growth year over year. Shown here are the four key financial metrics that paint a clear picture of Erie's financial performance. Firstly is revenue. Where we saw the most significant increase in revenue was from years 3 to year 4. During this time, revenue increased 70% as a result of bringing a fourth market-leading product into the performance segment and grew year over year at an average rate of 31.16%. Moving to profit, we are the only team to develop 4 products. This is shown by slow profit growth during the first 3 years, followed by rapid growth once all products successfully hit the market. As a result of this, our earning profits increased by more than 16 times our beginning profits in only 6 short years. Furthermore, the investment we have made to our capacity, coupled with our available cash, we aim to continue to improve our profitability measures going forward. Moving to ROA and ROE, we see a similar pattern as profit, which can be explained by the heavy investment years leading up to the delivery of our product. Seen during years 1 and 2 and years 4 through 6, we see this heavy investment. This typically is followed by rapid growth similar to year 3. Understanding this, we see the possibility of lost ground during these years, which is an area of improvement for us going forward. Finally, you'll see our team taking our stock price from $15.33 per share to $120.78 per share in only 6 years. This growth is a multiply of 8 times the initial stock price, and looking at our most recent 3 years of stock price performance, we see an average year-over-year growth of 56.08%. This has created significant wealth for our shareholders, and looking ahead, we are positioned to improve upon these numbers well into the future. Now I'll pass it over to our Chief Strategy Officer, Ernest Purcell.
Thank you, Michael. Let's talk some strategy. Initially, our strategic plan involved the adoption of a global niche differentiator strategy. However, upon evaluating the market response to our products, particularly EAT, as well as the competitive landscape, it became evident that a strategy adjustment was necessary. Also, we realized that if we did not adapt our strategy to include EAT in the budget market, we would be given most of the budget revenue and sales that EAT commanded back to the competition. And recognizing the need to incorporate a long-term budget product into our portfolio during the competition rounds, we undertook this strategic adaptation. The decision to modify our strategy entailed certain inherent risks, though, primarily stemming from the uncertainty surrounding our competitors' potential strategic adjustments. In response, we devised a hybrid strategy that predominantly aligned with our global niche differentiator approach while integrating a modest budget component derived from the broad differentiator strategy. Our team's rationale behind this hybrid strategy was based on positioning EAT at the optimal intersection of A and B on the perceptual map for the upcoming year. Additionally, by proactively positioning early and minimizing the need for frequent updates, we aim to maintain a favorable cost of goods sold level. And through this strategic positioning, our objective was to capture a substantial share of sales and revenue from the competition, while simultaneously maintaining a dominant position in terms of performance, aligning with our original strategic stance. By carefully balancing differentiation and affordability within this revised approach, we aim to optimize market share and financial performance, leveraging the synergies between our global niche differentiator and the slight budget-oriented broad differentiator components. With our broad strategy developed, we can now focus on our highest guiding principles or our mission statement, which is we deliver performance products at a premium price point by adapting and developing products to ever-changing local markets. And Jason will now cover our overall execution strategy.
Yeah, thank you very much, Ernest. So what I'd like to talk about is a little more in depth the strategy of our 4 operational areas. And those 4 areas are R&D, marketing, production, and finance. So if we start with R&D, as Ernest already mentioned, our strategy was to position products basically at the edge of the performance circle, and then to add kits to adapt for different market differentiation. So we made sure that we met the individual needs of the local markets. And as you can see the table there on the upper right-hand side of this slide, and it effectively shows where our products landed. And you can see the speed and accuracy, which was what Ernest displayed. You can see the service life was really at the high end of the market expectations. The age we kept low, and you can see how we did on kits. We did very well with kits, but we do have an opportunity in the future to add a few to make sure that we are fully rounded out. With respect to marketing, our strategy with marketing was to build forecasts based upon the market share that we had captured and the projected market growth, either in the performance or the budget space, depending upon where our products were positioned. With respect to pricing, we did require a premium price point to go with our premium products. And generally, what we tried to do is set the pricing at 50 cents below the high end of what customers were willing to pay. And then each round, we wanted to increase our awareness and accessibility to make sure that the market was aware of our products and that they could access them. With respect to production, we did invest in production capacity heavily to make sure that we could meet the market demands. Because these products were so successful, we did have to increase our production capacity every year, or almost every year, to make sure that we could meet this demand. And we ultimately landed at a production capacity of 5,000 units. This also was, even still, it was not really enough to meet all the demand. So we did have to do some outsourcing. And when we outsourced, we decided to outsource as much in the US as we could, because it was cheaper and more financially beneficial to outsource in the US than it was to outsource into other areas. We also increased our automation up to 7, and that was to improve our profitability. So we wanted to widen, create a bigger wedge between the customer's willingness to pay and our cost, so that ultimately we would be positioned to drive the most profit from our products. And finally, when we look at finance, when we assessed this business as a management team, when we first came in, we noticed that this business had been underinvested in. So we invested heavily in the early years to develop 3 new products, and develop our manufacturing capabilities. And that involved us taking out some long-term debt as well as issuing some stock. But as you can see there in the bottom right, you can see that we've done a nice job of generating cash flow, and our closing cash flow at the end of this prior year is over $80 million. And we believe that in future years, we'll be able to use that cash to pay down some of the long-term debt and maybe buy back some of the stock that we issued. So with that, I'm going to turn it over to Allison, where she can talk us through the lessons that we've learned and any recommendations she might have for the future.
Thanks, Jason. We next want to discuss some of the lessons we've learned and recommendations we have going into the upcoming periods. As you can see on the chart to the right of the slide, we ended the year outperforming all of our competitors. Despite our current position, that does not mean, however, that we haven't run into any issues or that we have an easy road still ahead of us. Looking first towards some of the challenges that we ran into in the past, we noticed that Europe had become unfavorable in the budget space. The action we took to mitigate this was to price Eat, our only product in the budget performance market, outside the budget range, and to drop its forecast in Europe exclusively. The next challenge we noticed was that R&D deviation times increased significantly, thereby blocking us from being able to make necessary product adjustments. The mitigation action we took to fix this was to ensure that our products were able to develop within the year. The last challenge we noted and mitigated was lost market share in the Asia Pacific region. The way we mitigated this was by increasing spending on accessibility and awareness. Looking next to the risks we currently see and our recommendations, we first noticed that automation has been delaying product development. We recommend that our team consider starting a new performance product outside the circle and at the highest performance level of anticipated consumer customer expectations. Next, we notice that our ROA and ROE are currently behind the competition. We recommend that we utilize our current cash to pay down debt and repurchase stock. Lastly, we've noted that our competitors have begun catching up to us in the performance class. We recommend better monitoring product pricing, developing our products farther to the edge of the circle, and adding additional regional kits where they're best seen fit. Thank you all for joining us today for our analyst briefing. As you can see, we've already experienced significant success and created favorable shareholder wealth. We are also confident that the future looks even brighter for us.